Are you someone who is really scared to invest in the market? Are you someone who don't know which route to pick to participate in the market? Whether to buy mutual funds or to pick a stock yourself and build a portfolio or explore other options like small cases and etc. If you're really new and don't know where to start but still want to beat the inflation kind of returns and FD kind of returns on a consistent basis, then index mutual fund buying is something that you should seriously consider. In this video, I want to talk about a simple index buying strategy that you can deploy and make reasonably consistent, predictable returns that can beat the inflation and beat the fixed deposit by miles. And also these returns can be reasonably predictable considering the nifty long-term performance as well. So stay tuned till the end because I've downloaded the data of a particular mutual fund and made some analysis with some simulations on the data where which is better. If you do a consistent SIP month on month, will that give you better returns? Or if you do a lump sum investment with some where if you deploy money only when the nifty goes down, will that give you better returns? Or SIP plus lump sum investment gives you better returns. I've made some kind of analysis which might be helpful for you to deploy this strategy and probably gain more returns than whatever the index gives you. So stay tuned till the end. A brief about index mutual fund. Index mutual funds are passive mutual funds that generally mimic the popular market indices. In India, we all know Nifty 50 is an index that we all follow, and Nifty 50 is a composition of the top 50 listed companies in India across all the sectors. The Nifty 50 mutual funds simply follow the performance of the index by investing in the companies that are part of the Nifty 50 index and in the same weightage as of the index. If you're buying an index mutual fund, you are effectively buying a small piece of all the companies that are part of Nifty 50, which is India's top 50 companies. So if Nifty goes up, the fund should mimic the similar kind of performance, maybe a bit of variance, at worst case maybe 0.5 to 1% variance. One of the biggest advantage of index mutual funds is its relatively low cost. Unlike say actively managed funds where the fund manager has to constantly buy and sell stocks in an attempt to beat the market, the Nifty 50 or say index mutual fund since it tracks the performance of the index, the fund manager passively just has to allocate the funds depending on the weightage of different stocks that are there in the index, and hence the costs of managing the funds are significantly lower. Hence your cost of you as an investor who invest in these mutual funds, the cost of you exit and entry load also relatively much lower when compared to other mutual funds. So if you are someone who believe that India will be in a better place economically and in our GDP growth is concerned in the next 5, 10, 15 years, then the simplest way to participate in the growth story is to invest in the top companies in India who are driving this growth, and the proxy of that is nothing but index fund. So what returns Nifty gave historically? Let's look at the quick analysis. I made this analysis which I'll put in the video description below for you to look at it and draw some really interesting insights about the Nifty returns, Nifty annual returns, and what is the average returns that the Nifty gave in the past, whatever the time frame, in the past 22 years, and how do you correlate with some of the macroeconomic factors, whether you have inflation rate is concerned, which I've taken here, and you have GDP growth rate is concerned. How does Nifty returns is correlated to some of these factors. The first sheet tells you the returns Nifty gave in the last 20 years, and you have filters here that you can change in terms of the time period is concerned and see in which time period Nifty gave what kind of returns. The second sheet, I try to establish a correlation between Nifty returns and the inflation. Inflation generally is the main villain for any kind of macroeconomic stability. So what's the correlation between inflation and Nifty returns? Is there a correlation at all? So we can figure that out in this chart. So I took the data from 2002 to nearly 2021. So I mean, consider this return. So each data point that you see is the annualized returns of Nifty. So you have about 20 data points that I've just plotted in a simple graph. And you have an average line that I've plotted here. So basically it tells you that Nifty gave about 15.9 returns at an average basis for the last 20 years. So don't mistake the average return with CAGR return. Those both are completely different in terms of the formula is concerned. So you have different time period here. Say for example, if I want to do this only from 2010 to 2021, then the graph completely changes and you have the average return plotted here, which gives you about 11.69 returns that Nifty gave. So this helps you to get a broad idea of what is the index returns on different kinds of time frame period. So if you impose inflation rate on the Nifty annual returns, then how does the returns change? Is there any correlation between that? So let's look at that. So the orange line is basically the Nifty annual returns, and the blue line is the inflation rate that you can see. And again, the light blue line is the average of inflation, and the pink line is actually the average of Nifty returns. What is the Nifty returns on an average during this time period? If you look at the turbulent times in terms of macroeconomic stability is concerned in India, I remember 2010 to 2013-14 kind of time period where Raghuram Rajan was one of the RBI governor, and he tried to take the inflation down at any cost and increase the rates like crazy, if you remember at that point. So that is a time, if you look at it, if I enter the dates here, say 2010 to 2013, you can see the average inflation here was almost 10%, and Nifty gave in that time period, Nifty gave at an average return of say 6-7%. And also you can see the Nifty returns, and it's like all over the place. There's so much volatility there because of the macroeconomic instability that's prevailing at that point because of the high inflation. So my only point here is that whenever there is a macroeconomic instability that caused by inflation, Nifty generally underperforms less than inflation. That's generally not a good sign. But here, for example, if I take a very recent period, say 2015 to 2021, then you have a much better picture here, where the average Nifty returns is about 13.25, and the average inflation is very well managed between 5.4%, which is roughly within the RBI's band. So even if you look at a lot of RBI meetings, they keep on saying that the inflation band that they're comfortable with is about 4 to 6%. So it's completely within the RBI band, and you can also see how the Nifty's gone up or gave kind of consistent returns during this time period. So, and even if you look at in the last 1 year as well, there's a lot of panic that's going on in the world, where the US inflation is out of the whack, the UK inflation and Europe inflation is out of the whack, and in India, probably first time in the history in the last 30-40 years where we have managed the inflation better. In turn, we have the better macroeconomic stability, and that showed in our returns in 2022. So I cannot say the same thing in the first month of 2023, because a lot of other things happened and we kind of underperformed a lot. But the 1 month aberration, let's keep it aside. Now that we understood that Nifty on an average can give about 12 to 15% returns on an average, provided the macroeconomic instability and inflation and everything is in control. Let's take an example of an index mutual fund, which is from HDFC, which is HDFC Nifty 50 Index Mutual Fund. I downloaded the data of monthly NAV of that particular index mutual fund and did some analysis that what are the returns that you get if you go via SIP route and consistently do SIP on the particular mutual fund at the start of every month, say 10,000 every month. And what are the returns that you get if you do, instead of doing an SIP, if you do a lump sum investment whenever the Nifty goes down by a certain percentage, what are the returns that you're gonna get? And if you do SIP plus lump sum, then what are the returns that you get? So let's look at the data. Okay, let me explain you the entire data that is there in front of you. So the column, this is the data, the monthly NAV data of HDFC Index Nifty 50 Mutual Fund. So I took the data from January 2017 to end of December 2022, or say starting of January 2023. And so this column B talks about column B is the date, which is the starting of the month or starting trading day of the month, and column C is the NAV at that particular day of the particular mutual fund. And then you have column D, which is the returns that this fund gave during that during in the last 1 month. So we calculate the absolute returns here, which is nothing but the current value divided by the previous value, and you calculate at a percentage level. And I just impose that copy paste that formula to the entire month, and I get this monthly returns in terms of the NAV is concerned for this particular fund. So considering that the fund is since we're talking about index mutual fund and it is mimicking the index, so I take that as an assumption that we're talking about the nifty returns more or less broadly, give or take 0.51% here and there, more or less mimicking the nifty performance here. So and the column E talks about what if you're doing say 10,000 SIP every month starting from 2017 till end of 2022. Okay, so if you're doing 10,000 SIP on this, then what are the returns going to be? The column F talks about the NAV points that you received, which is nothing but the 10,000 SIP that you're doing divided by the NAV. So what is the net points that you are receiving for that particular month? So here you have the calculations where the total NAV points, which is nothing but the sum of all the NAV points that you have received, which is in the F column, and NAV at the withdrawal time. So I took a broad example saying that NAV at the withdrawable time is about 170. So if you're withdrawing say in February 2023, if you want to redeem this fund of all the SIPs that you've done for the past 5 years since 2017, then considering that the NAV is at 170, then what are your returns going to be? The invested amount is about 7,30,000, which is nothing but the sum of all the SIPs that you've done consistently for the past 5 years. Then your returns are about 13.1%. I know you must be wondering what is XIRR and why have I put minus 10,000 here instead of say just 10,000. There is a basic difference that when we're doing a calculation between absolute returns, compounded annual growth returns, and the IRR, which is nothing but internal rate of return, or XIRR, which is nothing but an Excel way of saying extended IRR. The IRR, or an internal rate of return, is a measure of profitability of an investment or a project. It's generally expressed as a percentage, and higher IRR is considered to be more desirable than a lower IRR, as it indicates the higher return on the investments that you made over a period of time. So IRR is commonly used in capital budgeting in accounting terminology, and it's best used to compare the relative profitability over say a particular time period. So let's not go into too much details of the formula aspects of what is IRR and all the stuff. But let's look at it in a simple way. If you're calculating the SIP mutual fund return, what is the returns that I've got, what is the CAGR returns that I've got in my SIP, then the best way to go about is by using the XIRR formula, which is extended internal rate of return formula, that automatically built in Excel, in Microsoft Excel or any other Google Sheets, for example. So to calculate the XIRR, you need two components. One is the set of values and the set of dates. The formula is already inbuilt in the Excel, so we don't need to worry too much about it in terms of how to calculate and everything. So all we need to do is we need to modify our data to a certain extent. Say in this case, in this example, if I'm doing an SIP of 10,000 every month, then I consider it as a debit from my end, from my account. So I need to put it as minus 10,000, which is SIP that I'm consistently doing over a period of time. And when I'm redeeming the amount, the money comes to me, which is credit. So I'll just put it as a general number. So this number 11,34,000 is nothing but the NAV at the time of redemption into the total points that I've accumulated over a period of each month SIP that I am doing. So if I just calculate the XIRR here, then it gives me about 13.1 CAGR. So this is one scenario, right, where if you consistently do an SIP of 10,000 every month in this particular fund, then you got about 13.1 CAGR returns on an annualized basis. So consider the next scenario. What if since I know Nifty is not a stock and Nifty is not going to go to zero, I can be more brave here, right? So which means that whenever Nifty goes down, I double down on my investment, or I invest a certain amount whenever Nifty goes down, say more than 5% during the particular month, then how does my returns change? Let's look at this second scenario. Here what I've done is that same data, I'm doing an SIP of 10,000 every month, but whenever Nifty goes down, say close to 5%, I am, instead of putting 10,000 on that particular month, I'm putting 1 lakh in there. I'm putting a lump sum of 1 lakh, but I'm continuing my SIP every month as well. There are 2 months where Nifty has gone down by close to 5%. I'm putting 1 lakh each in that particular month. And if I do that over a period of 5 years, then my returns are going to be 14.2% instead of 13.1%. That's about almost 1% higher. So you must be thinking, what's the big deal, right? It's just 1%. And let's consider another scenario where if you decided to invest in Nifty whenever the index goes down, whenever the index crashes more than 5%. So for each 5% down tick during that particular month, you double up your investment. Say for every 5% crash, I invest 50,000. And if there is 10% crash in that particular month, instead of 50,000, I invest 1 lakh. If there is 20% crash in that particular month, instead of 50,000, I invest 2 lakhs. So in this the same data which I've explained in the previously. So if I invest 50,000 whenever Nifty goes down 5%, same here again 50,000 whenever Nifty goes down, 50,000 lump sum whenever Nifty goes down 5%. And then there comes the month where into 2020, if I because the Nifty has gone down by 25%, then I decided to put 50,000 into 5. That's about 2,50,000. So in this scenario, my invested amount is about say 7 lakhs, and the returns I got, say considering that I'm redeeming the amount at say 1st of February 2023 at an NAV of 170, then my returns will go up to close to 19.4%. That's incredible. So I know it's very easier said than done, because investing in Excel or putting money in Excel or simulating in Excel is different from investing in real world. Because who would have thought, if you take back yourself to March 2020 or April 2020, it's very difficult to put money during the crashes. But remember, that is when you can make a lot of money, especially if you're using the simple index buying strategy. Think of it in this way: Nifty is not going to go anywhere. Nifty will be there. It's not a stock like what you've seen during the Adani crash or any other scams that may pop up in any stock, any particular individual stock. Okay, key takeaways for me: invest in India, believe in India's growth story, because most of you who still go in a traditional mode of saving and investing, which many of you consider gold and property or fixed deposit as a mode of investing. That's kind of really sad in my opinion, because equities is one of the best classes that one can invest if you're looking for building a really long-term wealth. I know there's a lot of uncertainty in equities. I know there's a lot of volatility in equities, which many can't stomach it. That's one of the reasons why I believe many go far away from investing in equities. And you don't need to pick any stock. As I mentioned, you can just buy a simple Nifty 50 index fund. With that, I would like to wind up for the day. Thank you very much for your time, and thank you very much for watching. By the way, all the data that I've shown, the Excel worksheet and the Tableau public worksheet link as well, which everything is available in the video description below. Please have a look at it, and I hope this is useful. Please let me know whatever the feedback is. This is Pavan. I'll see you in the next video. Thank you very much for watching.